Well, good morning or good afternoon, depending on where you are at. How's everybody doing? Let me know if you can hear me clear or not. Awesome. Morning, Helen. Let's get some things shifted around here. Oh, quiet. Trying to pause that thing. I don't want to watch CNBC while I'm doing this. Morning, Kevin. Hello, Tom. What's up, Joe? Yeah, good evening, Brenda. Where are you at? If it's evening, I guess it's afternoon for some of you, huh? Just barely. Just barely. Thanks, Andrew. Whew. You ready for a big weekend? It's not really. My brother-in-law's birthday is. Actually, I'm not even sure when his actual birthday is. I know the party's this afternoon, so I'm gonna head up to Vashon in a little bit and have some fun. It's morning time here. It's only 9, so I'm still having coffee. I mean, this is only cup number 3. Usually I'm on 4 by now. But typically I quit after that. But let's get this stuff out of the way. I'm not a registered broker dealer investment advisor. I'm not going to give you any recommendations or advice. Everything we do here is purely for educational purposes. If I do happen to mention a trade, just assume it is a paper trade or practice trade. For regulatory reasons, we do not discuss funded trading here. Turn this phone down real quick so it doesn't blast off of my ear. It shouldn't, but never know. Just had a big cousin reunion last weekend, and we're all in one big thread. So there's been a ton of text coming through. But come on, how come the mouse isn't working? That's weird. Clicking on the screen, it's not doing anything. Okay, that worked. See if starting over will work. There we go. Okay, that was weird. Cup 1. Holy cow. I think I'd probably die if I didn't have my first cup till noon. My first was at 5 a.m. Here's what's coming up with wealth builders. You get Inner Circle, the 11th and 18th. Trade Watch Alerts, the 11th and 19th. Well, that's the Q&A. Wait a minute, August 11th and August 19th? That is weird. I'm gonna have to ask about that because believe that's a. Oh, okay, that is a typo, huh, Andrew? Okay, I think it's the 11th. Isn't it Monday? If I remember right, I think I saw that on my calendar. The the August 19th is for Mastermind. So yeah, it was a typo. It should be on the next line down. So Mastermind group is August 12th and August 19th. So it's all right. We forgive you, Andrew. It's no big deal. Not that big of a deal. Hopefully. Hopefully I don't get fired. I'm just kidding. Trading you August 21st. I think that's the one I'm doing. Muscle Market Movers August 27th. Trade Watch Alerts is August 11th. So this Trade Watch Alerts one is August 11th, which is Monday. I remember seeing that on my calendar. And then Trade You, I think, is the next Wednesday, if I remember right. The 21st, yeah. Power Hour every none on the 11th. That's every Monday at noon, but nothing on Monday. And then Trading Coaches Playbook, this one every noon. And then Power Option Plays. Of course, no pop next week. Rob's got stuff going on. Cover Call Explorer with Trip on Thursday. E-mini Think Tank with Brandon will resume on August 11th. Rob's on vacation. To get vacation, you can't take a vacation. I'm just kidding. You can find us on all the social media platforms, of course. So, and then if we haven't met, I think I know everybody here, but there might be a new one or two that pop in. But you've seen all my tools, I think. Hopefully, you've had them all, at least tried them. See if you like them or not, if they work for you. But Patterns in Flash and Weekly Whispers, Small Accounts, Big Returns, and Trade Watch Alerts. In fact, I just realized I'm supposed to have that background on there, but I haven't figured out how to do that yet, Andrew. I'm gonna need some help on that. So, but we're gonna go back to I don't know if I want to say basics. It's really not basic. It is one of the most important pieces to trading. Is why the patterns matter. Um, Decoding market psychology, which is really what we're trying to do, right? And I'm not sure about the word predicting, but we are essentially predicting future moves, like what is going to happen, what might happen next. Obviously, we never know because nobody has a crystal ball. But if you can learn to see the psychology, the sentiment, if you will, that traders are feeling by noticing, not only recognizing the patterns, but understanding them in depth so you can see the sentiment of people, see what is going through traders' minds based on the charts. Now, obviously, that can change. It's not something that is set in stone. It's not one of those things where you can say, oh, you're feeling like this. I mean, right? I mean, your feelings change from moment to moment, at least it can, right? You could start off with a great day and everything's good. You get some great news and you get a raise or whatever the case is. And then all of a sudden later that afternoon, you find out something bad happened. So your mood can swing from great to not so great, just depending on what it is, right? So same thing in the market. So we just never ever know. So, but if you can understand, like I was just saying, if you can get a deeper understanding of not only recognizing the patterns, but knowing what they are telling us, then obviously you have a lot better odds of figuring out what might happen next. As a second one, the patterns are visual representation of price movements and are historically repetitive, which is what we want, right? You want something that's repetitive, consistent, that historically will repeat itself because we want to consistently trade profitably. That's the ultimate goal, right? Easier said than done. But if you can see the patterns that happen frequently and repetitively, and they do the same thing most of the time, or at least a good portion of the time, then you got good odds of being successful long term. Patterns provide clues into supply and demand dynamics and investor sentiment, going back to the how traders are feeling, right? It gives us a competitive advantage. I mean, gentlemen, if you knew what your wife was thinking all the time, wouldn't you have an advantage and know what she's? It's like that movie. What was it? Was it Mel Gibson? What Women Want, I think it was. I saw it years ago, where he get struck by lightning or something like that, and he could hear women's thoughts. Wouldn't that be awesome? And you know exactly what they're thinking. You don't have to guess anymore, right? Sorry, ladies. It's just true. You can tell what they're doing. You have a competitive advantage then, right? Just like he did. I mean, you go back to that movie, he was an advertising guy, I think, and could hear her, he stole her ideas. So I am watching it, Brenda. I am being nice right now. Don't worry, I have an ex-wife, so I can go down that road a long ways, and she's not a good person, unfortunately. So I was too dumb to not see it early on, but it is what it is, you know. But getting to the psychology of the patterns and off of that topic, exactly. I was on point. You got to learn to recognize people's insanity. And I wasn't very good at that 25, 30 years ago. So I'm still not that good at it. I'm good at reading the charts, yes. But understanding women, nah. uh, Charts are reflection. That's one thing I've said for a long time is that they are a visual representation of what traders are feeling in that any given moment. That's why I always tell people focus on price. Other indicators can be good for confirmation, other stuff, but you got to remember and understand that all the indicators that you use, well, almost all, I should say, the MACD, the stochastics, RSI, Bollinger Bands, moving averages, those are all derivatives of the price. They're a mathematical calculation that takes past price history and smooths out the look of the price so that it's easier to try to figure out which direction it might go next. So almost every single indicator that you may or may not use is going to be lagging. There is no such thing in my world as a leading indicator. I'm not a big fan of that term. Nothing's going to lead the market. I mean, I understand where it comes from. I understand why people use it. I get it. I just don't like it because there's not the only thing that leads is the price. And that's not really leading, it's reacting. So, which is a good lesson for us as traders, is we're not looking to lead the market to do what we think it's going to do. We have to react to the market and what it's actually doing. It's easy to get caught up in that. Well, I think it's going to do this, or I think it's going to do that, or my opinion is this. And the market doesn't care about your opinion. It cares about what it's going to do, where it's going next. But if you learn to recognize, like I say, the patterns, then you can, and even just getting down to the basic candlesticks and analyzing what's going on with the movement of the candlesticks, that can be extremely powerful. Collective investor behavior creates recognizable, repeatable patterns on the chart. That is the beauty of patterns. That's why I've always loved them since day one. When I first started trading, I started getting into technical analysis, and I saw patterns. And somebody, I was like, "Oh, and I got a book. I can't remember. I think it was John Murphy's book, um, and I read it in like a week, 300 pages or something like that, which for me was unheard of. I hated reading because I was always bored. I'd fall asleep. My mind would wander because I'm reading the words on the page, but my mind's somewhere else. I don't know if anybody do that, but I think that qualifies as ADD. But yeah, I hate reading, and then all of a sudden, I remember finishing this book in like a week, and it's three or 350 pages, and I was stunned myself. I was like, "What's going on here?" I was like, "Well, I found something that captured my attention, something that I could get into, and I was fascinated by it." And then over the first couple of years, it was like, okay, I'm not seeing these patterns on the chart. I mean, I'm seeing them, but it's too late. I'm seeing them in the middle of the chart. It doesn't do me any good if it's already made a move, right? I got excited when I'd see it, be like, "Woo! Oh, well, it's already made a move. I can't make any money now. It's already played out exactly how it should." Ugh. That's where patterns and flash came from. I was frustrated and angry. So it's like, how do I solve this? How do I learn? How do I teach myself to see the patterns on the right side of the chart? And that's where that was born, is out of my own frustration. So, but there's the example, of course, head and shoulders patterns, a visual story of the battle between buyers and sellers, which is exactly what it is. And that's really what we need to learn to see is how do you differentiate who's got the upper hand? I go to tug of war once in a while. Who's winning the tug of war battle, the bulls or the bears? And if it looks like the bulls are winning, then obviously you want to be on that side. If it looks like the bears are winning, then you want to be on that side. If it looks like they're in an all-out fight and nobody's really winning, then might be best to stay on the sidelines or do a non-directional type of trade. Lots of different ways to go with it, but the key is being able to recognize it and see it and understand it. So we got continuations or reversals, right? Whether we're talking about price patterns or candlestick patterns, there's both in both categories. Continuation of reversals, flags, pennants. Continuation obviously trends likely to continue, right? If there's a reversal, a head and shoulders, double tops, potential change in the direction of the trend. The key again is to recognizing them. And of course, here's the good old flag pattern. And yes, I got the L in there. Years and years ago, I think it was actually 2000. I think it was the first year I started. We were out at a workshop. It was in San Diego. And some, Marquet. She was up teaching and she was teaching the flag pattern. And she was right. That was in the old days when you had overheads, right? We didn't have projectors or anything, and it wasn't PowerPoint. They hand wrote on the screen. And she wrote out flag, except she missed the L. And all of a sudden, the class, everybody just starts busting out laughing. I was busy doing something else. I looked up. I was like, and she turns around, and looks. Her face just went so beet red. She's like, "Oh my gosh, couldn't believe it." It was hilarious, actually. But anyway, that's what I always think about when I think about this pattern. Is that time in San Diego? But basically, what we have is, I mean, if it's literally a lot of these, you don't have to do anything but just think of, basic everyday life. I mean, a flagpole is, flagpole straight up, right? And then a flag's hanging off of it. So you get a pattern that looks like a flag, and then the expectation is that if it breaks out, if being the key word, if it breaks out, the expectation it's going to go higher. And we have what we call measured moves, right? Where you measure the height of the flagpole, and that is about what we expect it to move if it breaks to the upside and moves higher. Excuse me. So the beauty is that these are not inside patterns of flash. There's 30 or 35 patterns that you learn, right? But in reality, when you break it down, there's only about 6 or 8, because the flag pattern and the pennant pattern are essentially the same, except the formation, instead of being a flag, it's more of a pennant. So the beauty is, once you learn one of these patterns, you learn this, you now know a pennant pattern, because all you do is change the shape of this from a flag, a straight little kind of miniature channel, into a pennant shape, and you have a pennant pattern. Everything else is the same. So I know people get freaked out when they're like 35 patterns. Holy cow, how am I going to learn all that? Well, there's the head and shoulders, and then there's an inverted head and shoulders. And yeah, what do you think is the difference? One's upside down. That's it, right? There is one caveat that's more important on the inverted head and shoulders that we need to look for. But here's just a basic, again, kind of just a review. Kind of most of you have probably seen this, but I mean, obviously we're in a bullish uptrend, right? The stock's moving higher. You got point 1, 2, and 3, higher highs, higher lows. So we're in an uptrend. And then on the move from point 4, right, you got higher highs, higher lows. Volume is getting heavier here. Actually, there probably shouldn't be that arrow right there, but and then as it rallies from point 4 and makes a new high, breaks out of this high, we got lighter volume. So the bulls are in total control up to point 3. The bears give them a little bit of a fight, but then the bulls come back in. But a lot less of them come to the party than did before. So at the volume, and again, this is textbook. This is what we want to see. Do we see it all the time in real life? Not necessarily. But again, it's just the textbook. This is ideal if you can find it. That lighter volume indicates the bulls are getting weaker. So again, going back to determining what the sentiment of the market is, when you look at volume in the price chart, and I mean just basic stuff like higher highs, higher lows. Are we making higher highs and higher lows? Yes, we are. But how many people are coming to the party? Not as many. The bulls are getting weak. They're not as excited about this move as they were the previous move. And then of course it pulls back. And the breaking of the previous high is the first warning sign. Because a trend that's intact will use the previous high as a support level, right? You got role reversal going on there. Another topic to cover in there. That is the first warning sign that says, okay, the bulls have lost some steam. They're still in control because they've got higher lows still. They've got higher highs and higher lows still. When you look at this, higher highs, higher lows. The bulls are still in control, but they're getting weak. And then it bounces from 6 to 7. Ideally, you want to see lighter volume. If the volume is getting lighter and lighter on each of these bull rallies, that's obviously indicative of the bulls getting weaker and weaker. There's not as many of them coming to the party as there were before. So again, you can see the sentiment in analyzing just the price and the volume and breaking the previous high, which makes it weaker. Lighter volume on the rally up makes it weaker. So now you've got several indications that this trend is getting weaker. Then, of course, it rolls over there at 0.7, and now you have the actual formation of the head and shoulders. And this is where some people are like, all right, I'm going to get in. I would not suggest that. Because you know how many times I've gotten in too early? Like, oops. Because we have this thing that's called a neckline. So, and again, just like the flag, right? You think of a flagpole in real life, that's what it is. You think of your own physical body. You got the head, you got your shoulders, and then the trough, which is the neckline, which would be, you know, chopping your neck off, right? It sounds terrible, but that's where you draw the line, is in those two troughs where your necks connect, right? And the interesting part is that you'll see this, and this is where I made a mistake several times when I first started, is that I'd be like, all right, I'm going to get in here because the head and shoulders, it's a head and shoulders. And then guess what it would do? It would use this neckline as support because that's what it is. It may not be a real strong support, but it's a support. If it breaks, now we have confirmation. Now we have an indication that the odds are that we're going to go lower. If it breaks, not only is that a support line, but it's the neckline too. And ideally, we'd have heavier volume. If it breaks with heavy volume, that means, okay, the bulls got weaker and weaker as it rallied. So the trend was getting weaker because the bulls were coming, less of them showing up to the party. And now all of a sudden the bears show up to the party with a big volume move to the downside. That's an indication that the bulls have lost their mojo. So now there's several different ways to play this. I don't think I got that slide on here, actually. You can get in right here, right, as it breaks the neckline. Typically, I'll wait for the close. Depends on the situation, of course. Sometimes it's, you know, pull the trigger a little bit early if it looks like it's going to continue, right? Sometimes there's a lot of momentum. Sometimes, for whatever reason, there was something going on here that made it clear that it was probably going to continue. In other words, I'm not worried about it pulling back. But then there's the more conservative traders that worry about it taking off to the downside and just keep on going without pulling back. Because the traditional, maybe not a traditional, but the textbook pattern pulls back, right? It drops, it breaks through the neckline, The bears get tired, so they take a breather. The bulls come back in, and ideally you want to see lighter volume. So the bulls have gotten weaker and weaker on each of these subsequent rallies. And then it turns over, uses the neckline as resistance. We get a roll reversal, and it drops off. Right? This is textbook if you want to draw it. Now, it doesn't happen like that in real life all the time. In fact, rarely does it happen in a textbook fashion, but it does happen. And when it does, it's beautiful. Actually, there's one I think I've got a couple examples at least. Um, Now the question is, and I don't have this here, but I know it's in Pedersen Flash. The last slide is where do you get in? I am. This is just me personally. I'm an aggressive trader, but I'm also very conservative. I know that sounds crazy. So what I like to do is I blend the two essentially, right? It's like a hybrid. Huh? I don't know. Okay. 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 There's Ben. So what I love to do is I'll get in right here, but with a really small position, right? If it breaks the neckline and if the analysis is good, if everything's looking bearish, shortly after it breaks the neckline, I like to enter there, but just with one, two, three contracts, a small position, whatever that is relative for everybody. Because there's two different fears that happen. Number one, because you're going to have this happen if you haven't already, you'll see the pattern, you'll recognize it, you'll watch it, and then it will break, and you'll wait for it to retrace back up to here because that's what the textbook says it's going to do. But it just keeps on bleeding. You're like, ah! It's like one I had this morning. It broke out, and I was like, I should get in. And it ran. I was like, well, there's 2,500 bucks in 20 minutes that I missed out on, but so be it. Um, oh well. I still came back and got not quite that much, but I waited and waited for another setup and still got it's been a good day. So, um, but that is the part that freaks a lot of people out. If I don't get in here, it could just take off. But we could also get a false breakout, right? It could break down here and then break back up, and the bulls come back in and take it to the north side. So we have false breakouts all the time. So you've got to be careful not to get sucked into that trap, right? But if you pick up just one or two contracts when it breaks right in here, just a small position, if it takes off without you, now you're happy, right? You're like, okay, I'm there. I'm not making as much as maybe I would like to. You're going to be cranky about that. I should have bought all 10. Well, yeah, but you didn't know we could do that. If it does come down a little bit, if it comes back and does a roll reversal, then you can load more of it into here. If it gives you a false breakout, you of course should have your stop up here. So if you only got one or two or three contracts, a small position, it doesn't cost you as much if it's a head fake. But if it comes back up, taps that, and then takes off, now you can add to it and maybe get a full position or whatever it looks like makes sense. See, I get that question quite a bit. Well, how many contracts do you trade? Depends. Sometimes one, sometimes 10, sometimes 20. Just depends on what the analysis is, what the situation is, and how strong it is. If it's a really strong pattern, it's textbook, and it looks like it's really going to take off to the downside, I might grab 20 or 30. It just depends on what the situation is. So I don't have a static number. I know when I started, which in 2000 was a different ballgame because commissions were so heavy back then. I mean, most of the people that I worked with, most of the coaches I had were paying $200 and $300 and $400 per trade. So if you didn't buy 10 contracts, you're getting hammered on commissions. Your commissions were just a massive, massive piece of your trading. So it took a lot more capital to get started back then than it does today. And commissions are virtually nothing today. I think mine's like, I don't even know what it is, 39 cents or something like that. And then 20 cents a contract. I honestly have no idea. I don't even look at it. It's so inconsequential. I don't even worry about it. But it makes it a lot easier to scale now, either in or out, because you're not getting hammered on commissions. So that is a huge advantage for us as traders, and it makes this possible where you can get in, nibble on it right here, and then God forbid it's a false breakout. If you get stopped out, it doesn't cost a whole lot. And if it takes off, right, because you have that fear of losing, you don't want to lose a lot if you get in aggressive, but you're also afraid of missing out on the big move if it moves without retracing. So you conquer both of those fears by doing it this way, by being very aggressive, but doing it with a small position, and then waiting for a more conservative entry to load up on more if it looks like it's going to do that. I mean, you still have, it could obviously come back here and do this and then take off, but what we're looking for is more of a confirmation, more of a solid indication that this thing's going to move the way we are wanting it to. Clear as mud? Oh, the measure move, yeah. So all you do with the head and shoulders is measure from the top of the head down to the neckline. Whatever the distance that is, could be 1 point, could be 30 points, could be 70 points, depending on what the stock is, obviously. But that is our expectation of the move from here to there. So we can come up with a target. And it'll blow your mind. When you start seeing these patterns and you start, especially if you see them in the middle of the chart where they've already played out, you're going to look at them and just go, that's crazy. Because it oftentimes goes right to the target, right to the expected move, and then it turns around. Or it'll slow down and go sideways for a while. Doesn't necessarily turn on a dime, but it's mind-boggling how often it happens. And that every time I see it, even 25 years later, it still just solidifies my belief in the patterns and how powerful they are. The predictive power, right? They help identify entries and exits, manage risk. That's one reason I trade the way I do. Because then I have small risk out of the gates, small risk in an aggressive entry point. That way, if I am wrong, then it doesn't cost me a lot. Or if even if I'm not even wrong, even if the chart just doesn't play out the way I expected it to, because you're gonna be wrong a lot. But are you really wrong, or did you analyze it and you expected to do one thing and it did something different? But when we learn to recognize the patterns, you can anticipate the potential move. And when you have patterns like that, the head and shoulders, the flags, pennants that have a measured move, then we have an idea of what our target should be. And then risk management, right? That allows you to set stops. When you recognize the patterns, you set stops, just like I would put a stop just above the neckline on a head and shoulders pattern. So you can manage your risk well. That way, if it doesn't do what you thought it would do, then it doesn't cost you a fortune. You can combine it with other pattern or other indicators. I know I use price and volume. That is 99% of my decision comes off of that. I have moving averages. I've got Bollinger Bands, and those are a little bit of a factor. But the vast majority of my trading decision, I occasionally look at Stokes or MACD, but moving averages like the 50 and 200 day, those could be important things. I glance at them real quick, but they're not that big of a piece of the decision making process for me. 99% of it is price and volume. What is the price doing? What is the sentiment? Who's in control? Bulls or bears? And who's showing up to the party? Are more bulls come to the party? More bears come to the party? That's volume, right? Now, here's the interesting question. I've started playing with this more in the last few weeks: is AI and algorithmic trading, right? AI, and this is the interesting part, is that AI can speed up and scale the identification. I don't know about the analysis of patterns. I mean, obviously, it probably could, and it can scan for thousands of it. The downside, the challenge to AIs is that it will likely miss some patterns that aren't perfect or textbook. And I don't know if it'll ever get powerful enough to see the different variations. But I go through sometimes and I see patterns and I'm like, there's no way an AI thing would recognize that because it's ugly. Right? Some patterns are just not very pretty, but there's still a pattern there. And the crazy thing is that it seems like, and I've never actually kept track of it, but it seems like the ugly patterns actually seem to play out better than the textbook perfect patterns. So I'll find a perfect pattern, just be like everything, all the stuff. You find a head and shoulders like that, where the volume is just the way it should be. Everything's perfect, identical, and ideal. And then it does a false breakout. Then you get this just hideously ugly pattern, maybe a head and shoulders, whatever it is. It's like, oh my gosh, that's gross. Like, the volume's not the way it should be. It's just like, it's ugly. It's the shoulder's too small, or it's too this, or it's too that. And it's like, it's just gross. And then boom, plays out exactly the way the pattern says it should. It's kind of crazy. It just seems like more often that the uglier they are, the better they are. But I remember Warehouser like a year ago. It was just an ugly, like, and boom, it drops 3 or 4 points in like a week. I was like, holy cow, I should have traded that. But I didn't, right? Woulda, shoulda, coulda. Um, but one thing that we can do in algorithmic trading is accounts for about 60 or 70% of the market. And with AI taking over, not necessarily taking over, because AI won't take over the difference between the two is algorithmic trading is a human being putting in or building in parameters to an automated system, saying, look for this, look for this, look for this, and then do this, 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 and this. Right. So it's a human being actually making the decisions, but just programming it into a computer, telling it to do it when certain parameters are hit or when certain things happen, when certain things trigger. This is what I want you to do. AI is essentially doing it, it's doing the analysis part and it's building the systems automatically. So a combination of AI and algorithmic could become very powerful. And frankly, I think that's one of the reasons this just dawned on me in the last few weeks. I think that's one of the reasons that we've had this huge move we've had up in the last 2, 3, 4 months since March, April, whenever we bottomed out. A lot of that is, well, 67% is algorithmic, right? But now there's a lot of companies out there, and it dawned on me because I have a friend that is a real estate investor. He's a software engineer by day. He invested in real estate and he was buying a piece of property. I can't remember how we ended up talking, but he knows I'm a trader. And he goes, yeah, I found this AI tool and I don't have to do anything, right? I'm too busy. I don't have time to figure out trading like you know it. And he said, I just dumped a small amount. I just put 25 grand in it. And well, how you doing? He goes, well, in 4 months, I'm up 9 grand. I'm like, that's pretty good. That's like 7, 8, 9% a month. Um, and then I saw just a few days later, I saw this, I think it was on Facebook, some ad for Nirvana System where it says, our system will move the money into the stocks that have the most momentum. And I'm like, wow, that's crazy. And it dawned on me, I'm a little slow, obviously, uh, that the reason that we're getting these massive moves in some of these stocks is because these automated systems that people now the average Joe's use. It used to be algorithmic systems were only available to the big hedge funds and because it's expensive to code them, right? You got to have somebody that knows trading and understands it. You got to have somebody that either also knows computers and knows how to explain it to somebody that can build their algorithm out, right? The average Joe can't go and just create your own algorithmic trading system. The software is expensive and it takes a tremendous amount of knowledge, not only in trading, but also computers for the most part. But now with AI, that's becoming easier. And you don't have to be a mathematical genius or figure out how to do these algorithms. You can use AI to just go, okay, build this algorithm. And a lot of companies are doing that. So I think that 60 to 70% of algorithmic trading is likely to increase over the next few years. But watching some of these moves, I'm like, and then seeing this ad for this company that we move money from one stock to another based on the momentum, the more of those we have, the bigger the moves we're going to have. You're going to have these stocks that are, they should be done. I mean, Wayfair that I looked at yesterday, it went from 25 just 3 or 4 months ago. It's 75. It's tripled in price with almost no retracement. There's like 5 or 6 days in 3 months where it's retraced. That's it. Everything else is an up day. And I'm sitting in my mind, I'm going, this has got to be in part due to these systems that are automated where people are piling their money into those stocks. So the runs will likely be bigger and faster than before because the computers are doing it. And now you've got a bigger piece of the population who has access to algorithmic trading and they can do it just like my friend. I'm like, he doesn't know how to trade. He doesn't understand the market, but he just hands over 25 grand and he's making money. These algorithmic systems that they're using AI to teach, he's making money on it. So yeah, I think it's because that was the frustrating part when I saw Wayfair. I'm like, because I had it all planned out. I was like, I had a bullish trade planned on it. And I didn't jump on it. And then, of course, by the time it moved, it was like, it's already done. It's not going to go much further. And it just keeps going. It's like, what? And of course, the thought was number one, it's frustration. But as many solutions that we come up with come out of our own frustration, right? So my frustrating part is like, I missed that. Same with Dollar Tree. Another one. Not sure if it's algorithmic or not, but it certainly appears that way. But I missed a huge move on it. And out of my frustration, I'm like, okay, how do we figure out how to capture those big moves? And if this algorithmic trading that is now more available to more people is doing more of the trading, then those moves are going to be bigger and more volatile. So we can then adjust our trading to say, okay, I'm going to hang on to this thing longer because the reality is that this thing is there's a lot of momentum in the stock. there's more than likely a lot of these automated systems are buying this stock based on the momentum. So the momentum will continue for a longer period of time if those automated systems are continuing to buy it. Does that make sense? Of course, the opposite will work too. If it's, well, I don't know if any of them trade the short side of the market. Most of them probably do not. But if they do, then we're going to have the same thing on the downside. Is if they get in short and they follow momentum, and then these stocks that start to drop and they start to fall are going to fall faster and longer than they did before. So now we can justify hanging on, leave it a little bit looser stop and hanging on. Which when I do that, I'm usually only doing with a small piece of the trade. If I'm getting a big run out of stuff, I'm taking pieces of it out as it rallies. So by the time I get down to the last few contracts, if it's made a big move, I've already got all my money back and then some. So I don't have a specific AI tool I use for trading, and they're all over the map right now. If you look them up, um, there's so many of them out there that do so many different things. It's like the Wild West. It really is. It's really crazy how much stuff is out there. I'm actually finding some stuff that's actually helping me in other arenas besides trading, because I'm a little ADD, right? So um, trying to trying to keep things in line for me so I don't forget about stuff. Uh, but yeah, it's pretty mind-boggling. I mean, I would say dig into it. Go to Grok or whoever, whatever AI tool you can use. There's Perplexity, there's Claude, there's Grok. Grok's supposed to be the best one according to quite a few nerds. Um, that's the one I use probably the most. Just ask it a question. It's crazy how much stuff's in there. I'm starting to use that, and that's one reason Google is. I mean, their stock's doing fine now, but relatively speaking, they're not right compared to the overall market. I mean, Nvidia, Microsoft are hitting all-time highs. Google was not. Apple's raging because of the new, last 3 days, the news, whatever, bringing manufacturing back here, whatever they're doing. It's up a whole bunch today. It's up 4%. It's up almost $9. Just rounding like mad right now. Um, but Google is their search functionality is going to be dropping because people are going to AI tools. They're replacing a search engine with Grok, which I've done many times now. I go to Grok instead of going to Google because it will pull multiple sources. So I'm looking for this, or what about this, or how about this, or um, it's crazy. It's crazy. And like I said, I've just recently started playing with it. I know there's a lot of people that are way ahead of me as far as this, playing with this stuff goes, but it's yeah, it's mind-boggling. So, and it's only going to get better. In fact, Sam Altman was on this morning on CNBC, and they were asking him, questions about it. And what do you think is going to happen with this? And you think it's going to be get to this point? And um, so, yeah, it's a heck of a lot of fun for me actually. If you have a creative mind and you go, oh, I can do this, I can do it, I can solve this problem, I can solve that problem, I can do this, I can do that. It's kind of crazy. Um, but to every good sword, there's two edges, right? So AI can be used, it can be super powerful, and it can also be detrimental, just like anything. So and that's the thing that I think is going to be interesting is there's a lot of people that are in this mindset that AI is going to take over trading. It's going to make us into some super traders. We're all going to make like $3 billion, in the first hour of the market every day. And yeah, I don't see that. Mainly because if machines are doing everything, then well, and that's where the swings could get even bigger because if machines are making all the decisions, then they're all looking at the same data. They're all analyzing the same way, except they're not. Because AI is only as good as what you program into it. I don't see it. I mean, some people are saying that it will learn to think for itself, and I'm like, will it? And it can maybe, but it can only pull off the data that it has, just like we as humans do, right? I mean, whatever information you have in your brain is all you have to pull from. If you've never experienced something, if you haven't learned something, then there's no reference for it. There's no resource to go back and say, okay, here's how to handle this situation. It's like trading. I mean, if you're brand new to trading, guess what? You probably don't know as much as I know because I've been around for 25 years and I've done thousands, tens of thousands of trades. I watched others trade. I was a broker. I have lots of experiences that put all this data in there that I can draw on for experience, right? So if the data is not there inside the AI mind, if you will, then it can't draw from it. So I don't see AI ever really taking over. I think it's going to be a great tool if used properly. But it can also, that'll be the interesting thing to see how it affects the market. I think it already is. I think we're already having moves like that, like Wayfair that is up 300%, even though their profits I doubt are up 300%. In fact, I think it was the opposite. I think they came out with good profits last earnings season, but it still wasn't that spectacular. And a lot of stocks have been getting hammered lately because they're either not part of the AI thing, and Wayfair's they sell furniture online and they bring it to your house, kind of like Carvana, right? I mean, that's their main gig is house goods. Uh, and that the whole real estate sector's been weak. The whole economy is, even though the market is up, the market and the economy, and that's the other thing that I think is a huge red flag. You got all these politicians out saying, "Oh, look at the market's all time highs. The market's all time highs." That right there, for a contrarian like me, is the clue that says this trend is probably close to the end. Because when you get people talking about, "Oh, look at the economy is great because the stock market's at all time highs." Well, the economy and the stock market aren't necessarily directly correlated. In fact, they get disconnected quite often. Remember irrational exuberance, Greenspan? In 2000, you have the dot-com bubble, just going crazy. Stocks were going nuts. Everything was going up. Stocks they had nothing. They just went public. They didn't have a business model. They didn't have a plan. They had a plan maybe, but they said, we're going to do this. And all right, let's go public. Sweet. Making billions of dollars. And then they crash and burn and go to zero. So, yeah, it looks and feels a lot like that right now. It looks and feels very bubbly. When you see something like Wayfair go 300%, there's other stocks that have done the same thing. They've run 300%, 100%. Some of these airlines, I mean, Delta went up 150% or something like that over 2 or 3 months, 4 months. It's like, really? I mean, the stock price is supposed to be based on what the company profits, what the company's making. And when you see these big giant moves in stocks that their earnings and their fundamentals aren't changing that quickly, that means the stock prices are not necessarily based in reality. They're based in people's feelings and what they want to do. And it's a lot of it's pure speculation. People are buying a stock because they think it's going to go higher and then they're going to sell it quickly. I mean, the trading is getting more and more prominent because of the internet and the ability for the average Joe to trade. And now with AI making that algorithmic type of trading, automated trading, available to more average people, right? Like us, it just increases the automation, the algorithmic trading. And it will, I think what I believe it's going to do is increase the volatility. It's going to make the swings even bigger, faster, and further than they were before, which means if things turn over, if things start to get ugly, if bad data comes out like we had last Friday, and things worsen, then things can get ugly really quick. That's one reason. That's why I know a lot of people that love to day trade, just get in and out same day. That way you don't have to worry about overnight risk. So it's definitely there. But also knowing that, see, there's the beauty is that a lot of people are just pure bulls and they don't even think about the downside. I love trading the downside because it usually moves faster and further, and you get the delta flip if you're trading options. So I'm quite often looking for downside moves. I'm looking for an opportunity where a stock is exhausted, it's tired. I'm looking for a head and shoulders, maybe a descending triangle if something's already in a trend like Adobe. Um, so yeah, it'll definitely be interesting to see how AI affects things. But like I said, I'm pretty confident that it's going to make it wilder, which is good so long as you can recognize the patterns and understand what they are and how it's happening and take advantage of it. At the same time, it will to a certain degree because it will be a self-fulfilling prophecy for a lot of patterns. Because if the AI algorithms learn to see the patterns and they see it and they know what to do with the pattern, okay, here's the head and shoulders. If it breaks that neckline right there, then get me in this position. They automate that. That would actually be in favor more of me, my style, which is to get in with a small position. Because if selling starts to accelerate because the system sees it and says if it breaks that, then get in, then short the stock, it's going to create more of a push to the downside. So I think the swings are going to get bigger. The key is to identifying stuff, right? And understanding what it is. Oh, yeah. Politicians need to stay in their lane. I know. How to use AI in trading? No, I'm not. I don't even know how. I mean, I have some ideas in my mind of what it possibly could do, but how to use it, how to implement it in trading. I mean, like I said, I've had some thoughts and ideas on what. I mean, there's already systems out there that people have built software that goes out and finds the patterns, which can be good, especially if you don't know how to recognize them. I mean, I trained myself 18, 20 years ago how to recognize the patterns, so I don't necessarily need the software except that um, uh, it would be easier to find certain ones, but I still would not want to miss the ones that are possibly good because of that. And realistically, I mean, it takes me, I flipped through 300, 330 charts. I did it last night, all my research in 10 minutes. I'll just turn on some music or put on some thing I want to watch on YouTube and flip through it in 10 minutes. And then I've found some, and then I take another 20 or 30 minutes and dig through those and find the best of the best, analyze them a little deeper and go, okay, these are the best ones. And I usually have 20 or 30. That's what I look for the week. So it's not like it's super time consuming because I'm not looking through thousands of stocks. But could I use an AI tool and go find a whole bunch of patterns in arenas or places that I maybe wouldn't normally look that don't come down on my list on my yeah, I could. I could see that being phenomenal and also have it scanning through the options and making sure, the OI rules, all the rules we have in place. You can literally take and I mean, you can have it build you certain code. I mean, you can have it say, do this, do this, do this. If you can tell it what you want it to do, it'll build it. It's crazy. I play with that a little bit, and that's where my mind starts going. It's like, okay, I want this, 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 and this. Here's my style of trading. I had to do a risk reward calculator last weekend, the weekend before in the inner circle. I went to I think Perplexity or Claude or something like that. I said I need a risk reward calculator that does this and this and this, and then boom, comes out, writes all this code, and then it actually puts it in a graphic and creates this little calculator. I was like, wow, that's cool. I had never done that before. And I said include options. And boom, it went and rewrote everything, and it did this. And I said I need it for scaling in and scaling out, so I need multi-leg positions. I just told them those things, and boom, it built it all, created this calculator. I'm like, that is awesome. It's crazy. So now it's easy for somebody like me that doesn't know how to code, doesn't know how to actually build things. I could take my ideas and go, okay, I want this, 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 this. That's where I'm having fun with it. So how do you get AI? Just go to a website, go to Perplexity, perplexity.ai, grok.com, GROK. That's Musk's. Supposedly, according to a lot of industry, those that are out there say that that's the best one right now. Um, but they're all really similar. I mean, I don't think there's probably not a whole lot of difference between them, but um, I mean, the big thing that's going to differentiate them is how much data they have to pull off of. So, um, yeah, you can just go grok.com. That's the one I use most of the time. But I've started playing with some of these other ones. So, all right, see you, Andreas. Um, grok.com, grok.com. But yeah, that's wild. Whenever you have something, if you want to do something, just tell it what you want to do. You can upload files to it and have it clean them up. I mean, I've done that. I got a text file the other day and all this extra junk in there, all this coding stuff in there. I went to Grok. I was like, hey, can you clean this up? I want all the coding language taken out of it. And in a matter of 30 to 60 seconds, this thing went through it, brrr, brrr, spits it out right there, puts it out, and it just gives bullet points of the important stuff and took all the other coding crap out. It's crazy. It's crazy. I had to redact stuff. I had documents. It's like, can you redact this information from this document? You just upload a PDF and it'll find the information and I can't remember if it deleted or put X's. That was a while ago. I was playing with that. I was like, it just took all the information out of there or it crossed it out. I don't remember what it did, but it's wild. It's wild what the things will do. So, and I'm like I said, I've just started playing with it in the last few weeks. I know a lot of people that have been playing with it for a lot longer than that. And yeah, it's crazy. So anyway, let me get back to this. So here's some examples of patterns that have happened recently. That was 7-9 when the pattern showed up. Right, nice head and shoulders. This is core weave. Not that old of a company. It just went public and it went crazy. I mean, it opened up at was that about 50, dropped off to 35 or so. Excuse me, and then it went up to 180. I was like, here's the volume and stuff. Here's that momentum, which I think this second leg, and this is where again going back to the AI. if you have trading systems that are pumping money into where the momentum is, the AI system's going to see this volume and the momentum, and it's going to probably keep it going. They're probably going to take people's money and start pumping it into CoreWeave when it comes up. And here's the other thing. I don't know if this is the case or not, if it's happening, but does an AI system go out and go, there's a head and shoulders? If it breaks that neckline, then get in. Because there's what happened to it, right? It broke it just barely, closed below it just barely. I mean, it essentially was on it. 1 or 2 days later, it kind of danced around it for a couple of days, and then boom, it dropped off. But this was it 36 points? And it dropped 20 points in the first just 2 or 3 days, had a bounce, and then it ended up coming down to the 4-to-1 risk reward, almost about 40 points. So it dropped from 150 down to almost 100. It probably intraday hit 100, so it dropped 40 or 50 points. So that's a big move. Um, so yeah, it's obviously patterns can be powerful, right? That's the beauty of it. Here's one that I shouldn't use as an example because it makes me cranky, but the first thing I saw is on a weekly chart, it's a double bottom. On a daily chart, it's spread way out, so it's not really, but it's definitely a nice base building, whatever you want to call it. You could say an ascending triangle if you put a little line right here, right? Could consider an ascending triangle, but the entry points they're just below 80 with the target up here at basically 100. The 3-to-1 target's about 100. And that thing just took off. It gave multiple days actually. It danced around here for about 3 or 4 days. It hit that 79.87 area multiple times. I remember seeing it break out because I had an alert on there. I was like, I'm gonna wait and see if it pulls back. Be conservative. And I ended up not pulling the trigger on it. And here we go. 2, 3 months later, it's at 115. And I'm like, there's at least a double, if not a triple, on an option trade. But it happens all the time. You're gonna miss trades all the time. And is it fun? No, it's frustrating. The key, and speaking of patterns, and that was one thing I was originally thinking of with this, is that um, one of the most important patterns you've got to learn to recognize is the conversation you're having inside your own head. This is a mindset game more than anything. Learning to recognize the patterns, learning what they do, how to analyze them, how to see the sentiment. Um, that's relatively static. The sentiment part's a little bit, that's very subjective, but at the same time, that stuff doesn't really change. I mean, I originally built patterns in a flash, 2010 we launched it, 2007, 2008 is when I started working on it. And nothing's changed. I mean, the patterns are the patterns. Um, I mean, obviously they can be accelerated if AI accelerates the breaking or the movements of the patterns, but the patterns are still there and they're still the same because it's based on human behavior. And human behavior hasn't changed for thousands of years. It's been the same throughout history. So if you learn to recognize the pattern, learn what to do with them, then there. But the main thing in trading is to learn to manage your mindset, is recognize the emotional patterns that you have yourself so that you can adjust and adapt for those. Because that is the challenging part of trading, is keeping your head straight. Hence the reason I trade the way I do, where I'm scaling, getting in a little bit here, a little bit there, getting out a little bit here, a little bit there. Unless this looks really, really good, and then I might go whole hog. But it's pretty rare these days where I get into a full-size position right out of the gates. It's almost always a scale in or scale out. Because my goal is to minimize my risk. See, when we get started trading, the first thing you do is like, how much can I make? And all you're focused on is how much money you're going to make if it does what you think it's going to do. Because you haven't realized yet that it's quite often that it goes against you. Right? And that is what beats you up psychologically and mentally, is that you plan for and you expect it to do what it did, right? Because when you tell your kids to go clean your room, they go clean the room, right? Or at least they should. And if not, then you can use your authority to force them to do what you want. Can't do that in the market, right? The market's going to do what it wants to do, whether you like it or not. But we have this because we control everything around us in our life and we expect a certain outcome and we get it more often than not. We come to the market expecting that same type of thing to happen. It's like, oh, well, here's the pattern. Here's this. It's going to do this. It's going to do this. And I'm going to make $15 million in 30 seconds. And so you go down that positive mindset of, I'm going to make this much, but we don't focus on the risk and go, how much could I lose on this? And then after you trade some, you realize that you're going to be wrong quite a bit. And some of us a little slower than others. It took me a while to figure it out, but just in the last 5 to 10 years, I've realized that managing my risk is the most important thing. And the biggest part of managing that risk is the psychological risk. Especially, I just saw a guy posted somewhere on this thing about uh, had this one day he got hammered, a day trader. He got hammered on one trade, lost like 16 grand or 36 grand or something like that, a massive amount in one trade. And even though it was a few months ago, he still has PTSD from that one trade. It's still affecting him. So one thing I've said, because we all talk about stops, right? Putting your stops in and making sure you stick to your plan and get your stops. But if you've been trading more than about 3 days, you know darn well that you've gotten into a trade and you go, oh, I'm going to move the stop. Or you take the stop out completely. And it gets worse, it gets worse, it gets worse. And next thing you know, you're praying for expiration to get here so that stupid thing will be out of your account. I've done it many times. Everybody I know has. Every trader I know has done that. Most traders blow up their account at one point or another. Um, so the key is to not only managing your risk, but more importantly, managing your mindset, recognizing the patterns. And one thing I say quite often is that if you're going to stop worrying about the financial loss, when you get hit on a stop, the financial loss is nothing compared to the psychological loss, the emotional loss that you will have in trying to overcome a massive hit. Just like that guy. That's why it hit me this morning. I'm like, yeah, he fell into that trap. I've been there too. Most people have. You take one massive hit, and although financially it sucks, it's no fun, and it can be devastating, the emotional part is way, way harder. I mean, this guy was talking about how he bounced back, he came back, but that one big monster trade that hit him is having a massive effect on his ability to trade more effectively now. So stop worrying about don't look at your stops and go, I'm gonna what am I do I get out or not? Do I hold on to it? Do I take your stop, get out of it? Be more concerned with the emotional consequences of not getting out. Because if you take a 300, 500, 3,000, $5,000 loss, whatever it is you're working with, if you take a relatively small loss, it's not that big of a deal. You can overcome a small loss with one good solid win. I mean, yesterday I was down on my day trade, I was down $400. And even though I placed 3 trades that day, that's my max. It's like I'm only doing 3 trades. I broke the rule the day before and went from a small green day to a small red day, which had an effect on me psychologically a little bit, but not bad. But it bounced back, and it's like, okay. And I had 2 trades that were basically break even, or actually, I made a little bit on one, lost a little bit on another, and then the other one was a medium sized loss. I was down 400 or 460 or something like that, which is it's not that big of a day, right? It's not that big of a deal. It's not what I want. I obviously want to have green days every single day, but it's not going to happen. But I'm looking back at the 3 trades I did, and I'm like, I did all 3 of those. I didn't do anything wrong, really. I could have plucked the profit on the one sooner. But as the trade was playing out, my mindset is, okay, how much I can leave this on here because if it keeps going, then I get a monster hit. If it doesn't, then I'm still profitable no matter what. And it's a risk reward question. So how much risk do I have on there and how much potential reward do I have left? Okay, I'm going to give back $400 if I lose, but I got 1,500 of upside left. So it's the math equation in the mind going, how much am I willing to risk to get that potential upside? And it ended up stopping me out. Well, last night I was recording my weekly whispers, and all of a sudden I just happened to see out of the corner of my eye, I had the charting going. It was like, that looks good on gold. So I jumped in it real quick and boom, banked $850 in 11 minutes. Then this morning I got in, boom, $300 in 5 or 6 minutes. But what made me cranky, the worst one was about 5 or 10 minutes later, maybe 15, it's set up again for another good trade. I'm like, I probably should, but I was trying not to get overconfident because it's easy when you get a bunch of wins in a row, especially if they're big. You're like, yeah, I got this figured out. And then all of a sudden you get whacked. Well, I didn't jump on this thing because of that. I'm trying to keep myself humble. And I'm like, don't think you're, and boom, what happened? The thing would have been $2,500 in 20 minutes if I would have gotten in, but I didn't pull the trigger. I just sat there watching it like, freaking out. Like, But again, getting back to the mindset and recognizing the patterns, I've sat there and as I'm cranky and I'm upset that I just left a huge monster trade on the table. I have to reset my mind. Go, okay, don't let that affect your next trade. Don't let that affect your next opportunity. Wait for another pattern to show up. And if it does, then leave that one in the past because I almost pulled the trigger a couple more times. Like, okay. And I recognized the pattern in my mind. I'm like, okay, it's revenge trading essentially, reverse revenge trading, where you're trying to get revenge on the trade that you missed. Not trying to get back what you lost, but you missed a huge opportunity, an opportunity loss, if you will, and you're trying to get that back. And I recognized that this morning. I was like, okay, get out, just back off, just wait. I waited. I was super patient, and then it finally like, okay, now there's an opportunity. There's a pattern developing, double bottom, the volume's coming in. Okay, boom, hit it, boom, and in I think 15 or 18 minutes, ended up cashing out at 17 or 1800 bucks. So it was a good day. It was a really good day. Um, but that's the point is, and again, I'm not trying to brag or say anything. It's just that you have to manage your mindset. That's the hardest part of this deal. It's the most difficult part. Um, there's CRM. I'm actually out of time. I just realized, like, okay. So there's CRM. That's kind of in the middle of dropping off right now. That was yesterday's chart. But again, a descending triangle that is playing out beautifully at this point. It may change. So quick recap. Obviously, patterns are powerful at understanding market sentiment. The most important sentiment, like I just was talking about, is you've got to get your own mindset into the right place. You got to learn to recognize the patterns in yourself emotionally and how you react to them, and you got to put in curbs to keep yourself in the right lane. So, and that's why we use the old phrase, know thyself. You got to know where you're at all times, mentally and emotionally, and adapt for that for trading. And honestly, you can look at sports, and I use baseball as an analogy all the time. The difference between the pros and the amateurs is mindset. I know firsthand because three guys I grew up with, two of them specifically I grew up with quite a bit. The other one was a little bit older, so I know him and I've hung out with him a bunch, but not until we got older. Um, One of them went pro and the other two did not. The one that went pro was the least athletic physically. The other two were absolute physical studs when it comes to that. They had absolute God-given athleticism. Most I'd ever seen in anybody. Mark, one of my best friends, Marcus, just absolute crazy physical athleticism. Video games, every sport he picked up, he was stellar at. I played basketball and he's going like half speed, and he's kicking my butt. And then I would get a little bit ahead, or I'd get in a streak. I'd be like, and he would turn it on, and there was nothing I could do. I was just like, he's so fast, so quick, so coordinated. It was crazy. But neither one of those two guys that had the physical talent had the mindset. Whereas Burke did. Burke didn't have as much physical talent. He was still very athletic, but he wasn't as athletic as the other two guys. He went pro, the other two did not. It's all mindset because he fought through the hard parts. He did the hard things that he made it through the emotional hurdles that it took to get to there, because it took him a long time. He was in the minors for like 13 years before he suited up on opening day. He was he's probably one of the oldest to ever start opening day out, because he was like 32 or 33, maybe 34 or 35 when he suited up on opening day. It was 2007. He was in his 30s for sure. So, and most guys quit before they get there. They quit if they're in the minors and they don't make it, then they give up. They go back to their regular life. But he kept going because he had the mindset. He wanted it. And trading's no different. You got to overcome the mindset part. So, any questions real quick? Now we are over. We're always working on it. Every one of us is working on it, Brenda. It's always a work in progress. So it is trading ain't easy if you haven't figured that out yet. That's why I talk about the mindset part a lot, because those are the biggest hurdles to overcome. Learning strategy, learning the charts, learning that type of stuff it's not necessarily easy, but it's also not that hard either, right? It's something you can pick up on, like learning a language, learning how to drive. Once you figure out how to do it, you know how to do it. The most challenging part is the mindset part. And that's where that's why I tell the story about Burke, because that's where he differentiated himself from the other guys. He kept fighting through the disappointments, the frustration of not making it, thinking he's going to make it, and he's not, for whatever reason. So anyway. All right. Well, thanks for coming and hanging out and having some fun. You're welcome, Kevin. Hopefully you picked up a nugget or two here. So we will see you all down the road, wherever that may be. Have a great weekend, and God bless. Bye-bye.